When a CEO or a CFO refer to cash, there are two different concepts they may be talking about: cash balance and cash flow. While these may sound similar, they are two very different ways of measuring performance around cash. Let's use a personal example to help explain the differences between these two concepts. Let's say you start the year with $25,000 in your savings account. You've been saving it perhaps for a vacation or a down payment on a house or just an unexpected emergency. Now this is your cash balance. This is cumulative. It's probably the result of several years of savings. Cash flow, on the other hand, is what happens over the course of a single period or year. Referring back to our personal example, cash flow is more like your checking account. Let's say during the year you generate $60,000 in salary and bonus. During that same year, you spend $55,000 on expenses. Now, pretty simple. Your cash flow is $5,000. Now the fun part, deciding what to do with that $5,000. Well, it's your money, so you can buy new furniture for the house, pay off a student loan, or maybe put $3,000 of it back into your savings account, which would increase your cash balance. So, cash balance is like a savings account. It indicates how much cash a company has on hand at specific times. And cash flow is like a checking account. It indicates how much cash a company generates over a period of time. Now, one additional concept that comes up on many earnings calls is free cash flow. It sounds like cash flow, but it has an important nuance that you should be aware of. Free cash flow subtracts out capital expenditures, or CapEx, which is how much money a company puts directly back into growing their business, like building a sales office, hiring a customer service center, or buying trucks or computers for employees. If we refer back to our personal example, free cash flow is like your discretionary income. Say if you apply for a loan, the bank will likely be interested not only in your income, but your discretionary income, which is often calculated by starting with your income and subtracting your house payment and your first car payment. Now that makes sense. They want to know that you have some stability in your life, that you can afford your house payment, and that you have a car to get you to and from your job. You know, that job you'll be using to hopefully repay the loan. So in summary, the amount of cash a company has is a cumulative result of saving cash over time. It's a cash balance. Shareholders, employees, and other stakeholders are also interested in knowing how much cash a company is generating. That is cash flow. These key stakeholders also want to know how much cash is left over once capital expenditures are taken out. This is free cash flow. And free cash flow is money that can be used to help the business thrive, like financing acquisitions, paying dividends to shareholders, or paying off loans. Let's get back together as a group so we can have some further discussion around cash.